Jerome Powell tried his hardest to put the tough guy face on and pull the rug out from the market, stating that a December rate cut is, quote, not a foregone conclusion. Now, markets didn't like that one bit. However, when a reporter asked about ending QT quantitative tightening and the balance sheet freeze, Powell basically had to admit that QE quantitative easing was coming back. And although he had to use every bone in his body to not explicitly use the term easing, the market could read between the lines, and that practically marked the low of day. On the earnings front, after hours, Meta and Microsoft are gapping down, but Google earnings are gapping up. Kind of looks like a rocky end to the week, and therefore a rocky close to October. Oh, not to mention, we have had record-breaking bad breath days across the market as we've gapped up and printed brand new record highs. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily timescale, taking a closer look at the trend here. What do we see from that perspective? I know we didn't meet on Saturday. However, the Friday gap and go from last week technically recaptured the bearish engulfer high from the whole tariff debacle, what was now 3 or 4 Fridays ago. So that instantly produces a higher high in the daily trend count. As of Friday's close last week, the daily trend was back to up. Now, obviously, with the Monday gap and go and subsequent higher highs that have been made, of course, the daily trend remains in the upward direction. And I think it's very obvious, and I think a lot of people are probably talking about this, but the best pullback re-entry would look something like this to establish previous resistance as newfound support, turn this area into a daily higher low, and the trend will continue in the upward direction. So hypothetically, on the daily chart, you could pull back and close the gap to Thursday's high of last week, and there really wouldn't be any issues from a trend perspective. Now, does that seem likely given the candle structure that we've gotten over the span of this week's worth of trade? I would argue not really. It does not seem overly likely unless maybe earnings with Apple and Amazon go incredibly far south on Thursday after the close. That's the wild card that's still left in the deck. As of right now, during the FOMC meeting, when Jerome Powell again was trying to pull that rug out, talking about maybe wiping out the December rate cut odds, the market went as low as Monday's opening print and stopped there. It didn't even test the gap up from the Sunday overnight session when basically the whole premise was, okay, we're getting better news about the China tariff situation. It wasn't even close. So in my view, it's really not a market here where we're situated for this massive, oh my God, we're going to crash. It was a blow off top. Now, I know I made the same comment over here, but the only way we'll know when and if the daily trend is going to change to down is if we fail to hold a higher low here. So if the market takes out this level at 682 on the daily timescale, there will be intraday downside action to potentially trade. Something like a gap close to Friday's high at 678.50, something like the Friday low at 675.60, something like the full gap close at 672.65, right? You could trade these downside outcomes, but nothing has actually happened yet. Nothing has changed here from a daily trend point of view. The trend remains up. This is a brand new all-time high. It's the highest high in the trend count. And if a pullback were to emerge, we know that we can afford a daily high or low anywhere over the top end of this range. And also, just to add the little cherry on top, wouldn't that be something if the daily 20 played catch up and met us there? Beautiful confluence right at this level. Now, again, unless we really get something going south on earnings from Apple and Amazon, I don't think that this is really in play quite yet. And again, if we take a look at the hourly and the intraday chart, you can kind of see why. The market had every opportunity on that Jerome Powell rug pull to say, okay, here we go, new money sellers, let's start to get active. Or just anybody who is buying these gap ups, anybody who is long from terrible trade location, here's your chance to get out before the gap starts to close. And once again, did we go anywhere near the Monday low? Did we take out the Monday low? Did we take out the Sunday low? The answer was no. And of course, the catalyst that could sort of be tied to that is the admission of some degree of quantitative easing coming back at some point. Now, Jerome Powell mentioned that the balance sheet runoff date is going to be on December 1st. Okay, so it's right around the corner, basically. So that's bullish for the market. In terms of liquidity, that is bullish for markets overall. Think about that classic money printing GIF. It's not literally the same exact thing, but it's fairly close, and it would sort of indicate that that's the next step if they need to stimulate, right? So in terms of the base case on the spiders, the hourly chart here, what are we thinking about? What's the pathing into the end of this week? I mean, the only thing you can really do in a market trading at all-time highs is be a pullback buyer. Now, you'll notice a ton of different levels in here. We have an hourly level that technically acted as very close to the low. I would honestly probably remove that. The spike base has been absolutely influential. That's the equivalent of 6,900 on the ES futures we were watching into the close today during the live stream. I mean, just if we can hold on to that, this is total bull flag consolidation. Call this for what it is. And then over time, the Brigade bolt into new record highs is ultimately what you're looking at. Now, we do have the upper edge of the weekly expected move that's been coming into play for today's session and really the end of Tuesday's session. It might be possible that the market struggles to get acceptance above that, but if we do, the big target to the upside is the bearish engulfer range doubled, and that's going to be at 695. So that is the upside target from the measured move of the bearish engulfer from way back over here. If you could even think of this, again, I know we didn't meet on Saturday for the weekly chart review, but this is a 4-week balance range, and we've basically broken out of that. And to range double, right, whenever you break out of a balance range, the target measured move is the range double. That brings you here. That's the bearish engulfer 2x. That's 695. So that's what we have in terms of an upside target. And once again, if the market is just going to, oops, we don't want to get too much of a funky zoom going here. It's crazy what happens when these gaps hit the market like that. There we go. We don't want to have too much of a short bias here. I think if you were interested in scalping this on the short side, maybe there's something to do in here for the gap close, and that's fine. But I wouldn't overstay my welcome on the short side. I would probably be thinking about, okay, is there the possibility of gap fill reversal? And then, of course, the long, the more confident long, is when the hourly trend flips back to up via hourly high or low, back over something like the Monday low and the Sunday night low there around 682s. So that's one possible situation if the market pulls back to close the gap and supports over the Friday high. The next thing to call out would just be, again, if it does continue beyond that. So here you go. If you don't really support here and you continue through Friday's range, this is probably a tough trade to pull off based on the chop there. But if we were to move underneath Friday's low and close the gap in here, I would absolutely button up the short thesis, right? That's, I think, the key takeaway. If you're going to try to trade this pullback, just please don't be initiating new shorts as we're coming into the location where it's very obvious that a daily higher low could potentially develop. Now, over the span of time, there's probably going to have to be a conversation at some point, and I'm not here to be bearish, doom and gloom. Oh my God, you guys know I'm the permabull of YouTube. But if at some point this fails, and then we go lower high, we can have the conversation in the future about the potential for a head and shoulders, but let's not jump the gun. Now, I know, and if you've been watching the channel, you know I made the same exact comment right here before the tariff struck on that Friday session. The Wednesday midweek market update video, I was saying, don't fight this in the balance range. I get it. The tariff situation was totally out of left field. Unless you have a catalyst like that, it's very, I would think, probabilities say this is a highly unlikely situation. And the more likely situation is that if we pull back, this should attempt a daily higher low and the trend should remain in the upward direction, breaking out of a 4-week balance range with a bullish catalyst like quantitative easing coming back into the sort of sphere of influence, if you will, from a Fed perspective. So that's what I've got for you. Consolidation in here is probably just difficult and a headache to trade. We can go on down to the hourly chart again. Let's throw on some studies like the intraday anchored VWAPs. Notice that we held the Friday gap up anchored VWAP, and here's the Monday gap up anchored VWAP. We technically closed above. You'll notice that this is the Tuesday low level at 685.50. That's sort of where the anchored VWAPs will cluster as we move into the end of the week, right? As this kind of goes like that. If we can consolidate above, that's just bull flag consolidation, as we just mentioned from this perspective here. Let's break out the Fibonacci's and take a couple of measurements. The first one from, let's start really from the major low here to the high. So Fib 38.2 near the Friday high, just kind of reinforcing once again, this is still okay from a trend perspective. That's a higher low. 68.1 is the line in the sand. That's right at the key line in the sand from the daily perspective. That is the top end of the bearish engulfer. So that's also checking out and making sense. What if we come in from the Friday low up to the all-time high? We can currently see the 61.8 is in the gap area. It's the Sunday low. That makes sense. If you could generally stay above that, you're probably not getting the deeper pullback. I would align with that based on this fib. The 38.2 seems a little bit arbitrary in my view. It's kind of aligned with the spike base, perhaps, this anchored VWAP. You might get something there. I'm not going to second mortgage the house on these fibs up to the all-time high like this. And then if we come from here to here, how deep was the retracement and where did we close? We did dip underneath the 61.8. We did not close there. We actually closed over the fib 38.2. So all things considered, fibs, anchored VWAPs, and just reading the price action alone, it's very difficult to have a bearish stance here. And you would need a considerable change in trend on the hourly chart and the daily chart to really bring back out that bear thesis. If you really want to drive it home, home, you could just look at this and say, okay, if you're a seller, you see this and you're like, okay, this is the moment I've been waiting for. The market's going to capitulate. Here's the blow off top. It's game over. All of those shorts squeezed, right? Done. Game over. For them, it's game over, those shorts, not the market, for them. So as of right now, staying over that, if you want to keep things simple, if you come to these videos for just checking on the market, you're not really actively trading the levels, then as long as we're over 674, you can sleep like a baby at night and just know that, okay, the daily trend is going to remain up. If you start seeing the blotter underneath 674 and, the market minder window, I should say, is trading below, then okay, we've got some concerns, but we're just not there yet, and it's not even close based on candle structure. Now, I do have some concerns out of the market internals. And what we'll see here is, and I was talking about this in the pre-market prep, mainly let's take a look at the Tuesday session because all this volatility is going to skew the internals. But look at Tuesday. Tuesday was a rally on the NVIDIA GTC event, right? Well, under the hood, we had a historically bad breath. You saw the stat in the intro, but take a look at the market internals here. Volume flows were technically out, but yet the market made an advance all day. You can thank your one stock to rule them all, NVIDIA, for that basic premise, right? You could see the advanced decline line was under the zero mark, and yet the market's trending higher all day. You could see that your cumulative tick is flat, right? Really nothing. In terms of tick by tick data at the exchange level, there's like 5 stocks driving the market higher. That was going to be your NVIDIA, your Tesla, as well as AMD, right? Got that Department of Energy contract on Tuesday as well. So like these names are moving the market higher, but nothing else is going with it. And once again, you could see that here in the internals data. So are there some concerns under the hood that breadth is really narrow? Of course, it would be irresponsible to ignore that data point. However, what do we always say here at the Trade Brigade, right? If you've been tuning into the channel, you know this. Just like we say it's not a double top or a head and shoulders until it is, there's only one thing that pays you. What pays you? Price pays. Speculation on, oh my goodness, this is a top and, I'm going to bet against the trend, and that does not pay you. It's good context to have. It's good context to have to not jam this thing long at the high of day if things are starting to pull back, right? That doesn't make sense. Breadth is just not there to support it, right? You're not going to get a smooth consolidation. You're going to get a drawdown in the stock. So the context is helpful, but it doesn't mean just go out there and short the market with both hands. It means just be extra cautious of longs at the highest high in the trend count. So that's your market internals. And again, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Let's take a look over at our market profile and just see what's going on from this perspective. I was a little concerned on the Tuesday session with value, not drifting higher with price, but notice how on today's session, it is overlapping to up. So here's Monday. There's Tuesday, of course. There is Wednesday, today's session. Notice that the point of control is higher. We do have a poor high. Great excess in the K period low from the Jerome Powell commentary. All things considered, this actually looks a little bit more bullish than it does bearish, right? It sweeps these lows. It puts in an excess low here in K period. And now the all-time high level basically needs repair. This is the improper end of the auction. Now, we need to carry that forward because as of right now, post-market, you can see we're trading lower. The orange line represents the current trade price, and that's thanks to, of course, Meta and Microsoft earnings. So if we can stay inside it, or if we could just get back into, I should say, value area and consolidate here, it's probably a trade that looks to repair the all-time high and put an excess there rather than a major fade back off to the downside. And the thing to carry forward, right, is if we do fade off first, let's say the market does move lower, it does not repair this, then we carry it forward in the narrative as something that should be a target over time. It doesn't have to be a target on Friday, Monday, Tuesday, Wednesday of next week, but it should be something that we at least know in our back pocket that when and if we test the all-time high in the future, the first test should break it because it's an improper end of the auction. You probably have some easy stops there to go and run in the A and B period flat top. Okay, so that is your market profile. There's really no more nuance to pick up other than that. The only other thing I guess I would say is just reinforce the spike. And we talked about this on the Spider's Cash, but there's the base of the spike. We didn't even break it on the Tuesday session. We looked underneath, and buyers obviously propped prices up above that. So continue to carry forward that 6,900 level here in the ES futures. As long as we're above that in the short term, immediate term, like the here and now, there's really no problem. So tomorrow morning, if we open over 6,900, see a move to test it and hold, that would be bullish. If we just get opening drive on an open above that, also inherently bullish, and I would think about that all-time high repair up here. If you're not familiar with the market profile, I know I didn't point to the tutorial yet, but there it is in the top right-hand corner. Check it out. You can learn about what all these little references are that I'm talking about. Okay, K period is not a spike. I'll just give you a little tidbit here. K period is not a spike. M period is a spike. It needs to be the end of day. All right, let's get back on over to the platform here. We're moving a million miles an hour. There's a lot of stuff going on in this market. Let's take a look at what we have over in the QQQ NASDAQ. Now, if the market was opening or forecasting right now a substantial gap because of Meta and Microsoft earnings, I'd be talking to you about it, but you can see we're hardly changed. I mean, with the push and pull, the NASDAQ is printing 633.50s with a close of 635.70. That's still inside of this range. If the NASDAQ was printing something like 620, I'd be screaming from the rooftops about this gap. Gap rules the whole 9 yards. Same thing in the S&P 500. We're basically unchanged from the day's close. So that's just the context of where we're kind of at now. In terms of the daily trend here, obviously the trend remains in the upward direction. Our loss for breath. This is the highest high in the trend count. It's a brand new all-time high. You can clearly see that we closed even stronger than the S&P over the previous day's high. So that is pretty compelling in my view. Again, if we had stronger sellers, you would think that you would make a run for Tuesday's low and attempt some interaction with the gap down here, and it just didn't happen. So daily chart looks bullish, failure from the sellers to go lower. We are extended through the upper edge of the weekly expected move. Something that you should at least be aware of is the expected move is a suggestion from the options market based on market maker positioning and where ultimately the short delta is. So if the market makers are off sides, and I'm not saying every market maker is off sides and everybody's upside down and it's going to be this crazy thing, but one thing that you might think about here is the possibility of a gamma squeeze, right? If some, notice the keywords, the language is important. If some market makers become upside down because, oh my God, we weren't forecasting a move over 630.87s, and those options need to be brought back to delta neutral, what do they have to do? They go out and they buy the underlying stock. In this case, they could go buy, long NQ futures. They could go buy NDX calls. They could buy QQQ calls. They could buy 100 shares per contract of QQQ underlying. It doesn't matter what they do, but to bring it back to neutral, that is positive delta for the market. So the longer we stay above 630.87, and it's very rare that you would actually get a pure play gamma squeeze of the likes of an AMC or a GME on the index product itself, but the point still stands is it may be harder to get action back into the expected move the more time we spend outside of the expected move to the upside. So just a consideration to make here if these lows from Tuesday and today's Wednesday session stick and we don't move back underneath roughly 630. So the bearish engulfer doubling of the range, just to point this out, has almost already been hit, right? So if the market's going to squeeze above that, things could kind of get nutty here. I would definitely, I know I'm talking about this through the lens of like excitement and bullishness and oh my God, the market may squeeze here, but make no mistake, this is like a dangerous place to be buying new money longs after gap and go, gap and go, gap and go. I mean, the time to be long was maybe Friday on the gap up out of the multi-week range from back here. The time to be long is not at the top of the move currently at the measured move target, right? So although, yes, we're talking about these concepts, I want to be very clear that this is not the time to chase it. The time to chase it is here. The time to chase it is if it pulls back and offers this support, just like in the S&P 500, that's your clean daily high or low, and the trend count remains intact. You do have your daily 20 SMA, which will meet you there just like the S&P 500, and the full gap close is down to 611.40. These prior highs are mixed in around 613s. Okay, let's take a look at the hourly time scale. Not going to learn a whole heck of anything different here. It's just up and away, floating off into Never Neverland. Brigade Bolt over, roughly 636.65, and of course the bearish engulfer double at 637.65, $1 higher, should bring uncharted territory. There's really not even a measured move to use for that particular outcome. If you're consolidating in here, it's probably not a market to short until you're actively at least inside of the Monday range. You could see, and my logic for that is basically that on the Jerome Powell speech, you would have thought the bears needed to accomplish a lower high in Tuesday's range if the sellers were going to come out and really play ball. And it just didn't happen. The close was once again over the Tuesday high. So I don't really even want to be bearish back in Tuesday's range. I would just let the market balance and chop in here. October has been a very, very tricky month. I don't know about you guys, but to me, to end October here, I want to take my foot off the gas pedal and not keep jamming it up at the highs, especially under the conditions that we're looking at here, especially with what we just talked about in the NYSE internals. We'll see the same thing basically here. I don't think you're going to learn much if I just throw on the, let's just quickly throw on the intraday anchored VWAPs. You can see the same comment as the S&P 500. If I come in here with the fibs, we'll just do it for the sake of being very congruent and thorough. Same investigation, 61.8, 38.2. We could come in here from the Friday up to the high, same thing, 61.8, gap fill underneath, closing over the 38.2, bullish. Then we could come in from here, right? Same exact concept, 68.1, no need to talk about the 38.2, we closed above, bullish. So no new insights here, just trade all the levels, all the concepts are the same, but let's continue to look through what's under the hood. I think what matters most right now is what's under the hood. So even on Tuesday, when NVIDIA was driving the market higher, which has more influence over the NASDAQ, you did have negative volume outflows. You had an advanced decline line that was negative. You had a cumulative build on the tick that was negative. Obviously today, with the Jerome Powell volatility, negative, negative, negative over here as well on the cumulative build. So all things considered, it's really not all rainbows and butterflies. Again, I know price is what pays, but chasing this at the highs is a very dangerous game to play when breadth isn't there. All it's going to take is a pullback in NVIDIA, and this market's coming down, probably more substantially. Now, I'm not forecasting that, or I'm not positioned and speculating with money on the line that is going to happen, but it is a situation that I am at least acknowledging as something that will provide intraday downside opportunity when and if NVIDIA pulls back hard, which it won't change the daily trend yet. We'll talk NVIDIA in just a second. That will put pressure on these index products, noting that the underpinnings are not performing well. That's what that's the whole reason for looking at the exchange level data on a day-to-day basis, right? Let's go on over to the market profile for the NQ. Quickly take a peek at what's going on over here. Let's reset this view a little bit. Same comments, excuse me, as the S&P 500. Apologies. We have value shifting higher, point of control higher, great excess low, lack of material excess on the high. I'm going to save the breath and move along to the small caps, which of course are the most sensitive to Jerome Powell's comments anyway. So let's take a peek over here. Really not liking the whole maybe, maybe not on December. You can see this is the only solid red-bodied bar that closed. You can see it's the only bar that closed underneath the previous day's low, and you can see it's the only chart that's trading underneath Friday's low as well. So a lot of divergence here in small caps, not responding favorably at all to what was happening with the Fed today. Now, the flip side of this coin is that you're also not going to get the earnings pressure over on small caps. You're not going to see Google earnings impact this to the upside, but you're also not going to see Microsoft and Meta impact this to the downside. So you're pretty unchanged here, and I would argue that you're in the neutrality zone for small caps. In here, there's really no edge. Back over 248.25 is bullish. This is looking for ultimately, ascending triangle is likely the pattern that will develop. You get something that looks like this, all-time highs above. If you break down underneath this, I would start to think of it as a distribution pattern and really start to hammer the shorts when and if, emphasis on that statement, when and if we're underneath 238.50. We're not there yet, but this is absolutely more neutral than the S&P 500. I think that this ties in with the breadth narrative as well, that you're only seeing a select handful of companies fuel the S&P and the NASDAQ higher. Let's take a peek over at the internal side, the hourly side. Notice that there was no big recovery effort here. The small caps didn't care as much about the quantitative easing bit. You could see that if a lower high is produced here, that will accomplish look above and fail overhead supply. So looking for shorts up against 248.25 is a short-term short, which likely provides downward pressure in the S&P, possibly causing a pullback. So if you're trying to navigate the pullback in the S&P, if you're someone who wants the market to pull back, then make sure that your Russell rally goes no further than 248.25. If it goes further than that, I don't want to say you're out of luck, but it would just be much harder to jam the market short without participation from small caps, which is more of a representation of breadth continuing to deteriorate. Let's jump on into our Russell internals and see what we have over here. You got mostly the same as what we've been talking about, even weaker on the Monday session though. Monday, unlike the other index products, was, here's Monday here, was even weaker, right? Monday on the S&P kind of sideways and flat, same thing with the NASDAQ, sideways and flat towards the highs though. Not the case in the Russell, and you could see the bearish build on the cumulative really starting to hammer that home. So the breadth of the small caps is not conducive to continuation in the market, and the risk lies on the concentration factor over in NVIDIA and the mega cap tech. If we go on over to the Russell side of the market profile, let's quickly take a peek over here. You've got yourself a substantially different look with value progressing lower. Today is fully engulfing, but earlier in the week, lower, right? Relative to Friday, lower. Value is engulfing of the Friday value, right? Rather than just being clean and break away to the upside. There was no gap up on the Sunday night into Monday open. None of that. So yes, you do have the good excess low in M period, but this is actually a spike. Right, so M period spike tells us everything we need to know. I think tomorrow, if we open over the base of the spike, which is roughly, let's just call that 2480.2 2482. We'll use a nice round number. Over 2482 on an open invalidates sellers, right? Classic spike rules. If you don't open in this spike, then anyone who is short from the low of day is going to be feeling like this, right? And anything that stays over, that's 2842. 2482, gotta get the numbers right. Anything that stays over is going to put the pressure on the shorts, and then you probably just get more of a balanced session than a breakdown. Now, if you get back underneath that level, that's probably where you say, okay, bear flag, break previous day low, and you go with in the downward direction. Or if you're just looking for a helping factor over in the ES, that's where you become a little bit more bearish, looking for the pullback in the S&P side of things rather than being a little bit more reserved. Let's clear that up. Let's take a peek back on over at the sectors here, and let's go through our sector watch. You can see this abysmal breadth in the sector performance also. Semiconductors lead the pack, up 3.06%, followed by tech sector, up 2.16%. Aside from that, red. I mean, I'm not going to bore you and kill your eardrums by saying it over and over again, but there's nothing else green here. If you're not a semiconductor name, if you're not related to OpenAI, if you're not related to NVIDIA, good luck. Best of luck to you, but you're just going to... We'll let you drift over there and drown and deal with it on your own. It's semiconductors only, right? So jumping in, and that's a concentration concern. Now, thankfully, this is the heaviest weight component of the market, right? And as long as that's afloat, it's probably not enough to sink the ship. But it certainly means if this does not rotate, if you do not see money on a pullback come out of tech and semis into things like healthcare and financials, then good luck. The market is not going to sustain an easy pullback. It will be a harsh pullback. Okay. Now, if it's harsh, sell everything into this, I would make note of that. I would be a little bit more cautious of just blindly buying this and resting limit orders down here to add to the long-term account. If the market is rotational, then fine, I'll buy this, no problem. If the money's coming out of tech into other sectors, awesome. I'll be a buyer here. If it's not, then I need to see it to believe it. I need to see the structure here to believe it and not just rest limit orders, right? Let's get into these charts. SMH. I mean, what do you even say about a chart like this? It's bullish until proven otherwise. There will be a pullback at some point. It will come in and close these gaps at some point. I shouldn't talk as if that's an absolute, but I'm saying if it comes in and pulls back and closes these gaps, fine. It's not going to change the trend until we retake out this breakout level, which is around 346.75. Okay, these prior highs, as long as you're above them, just like we said in the S&P 500, if you're above these highs, you can sleep like a baby at night. If you're back below these highs, okay, oh my goodness, this is a failed breakout. What is going on here? No good, right? So watch your 646.75. That's the only obvious level. Same comment over here in the XLK. Watch your, 291.35. As long as you're over 291.35, no problem. Looking for a higher low in continuation. Let's take a look at real estate. A little bit harsher, obviously, with the lack of confidence on rate cuts for December. Real estate's very rate sensitive, obviously. Moving through the bottom end of the balance range. This is what we're talking about when we're dealing with rotation that's not really stepping in. Your interest rate sensitive sectors aren't really seeing the benefit of rotation based on Powell's comment. If you look at XLP, absolutely smacked today. Just falling more than off of a cliff, just completely ruined. So this is a huge drag, I would think. Thankfully, it's a lighter weight sector, and it's also D for defensive. So not the end of the world, but in terms of that rotation, it doesn't give me a warm and fuzzy feeling inside to say, oh my goodness, the rotation's fine. Staples have been sideways. If the pullback in tech comes, then maybe this breaks out of range and everything's all great. That's not at all. That's not even close. I mean, this is huge breakdown out of XLP. And again, thankfully it's lightweight. It's not going to drag the market too much lower, but rotation-wise, not really what you want to see. Financials, another one that it was doing well earlier on in the week until this morning. Large gap down underneath this 52.90 gets us back out of this overhead supply range. The best outcome would have been consolidation and then continuation over time. Think rotation, right? Tech pulls back, financials recatch a bid. We're up and away. There's nothing happening here in terms of that type of improvement. And you could probably thank no one other than Visa, downside on earnings over here, and some of the others. I mean, maybe PayPal, although that falls a little bit more into the fintech category. JPM, just kind of loose and sideways. We'll get into those names. But for the most part, financials are a threat to the sector performance, noting that we're underneath this balance range here. Let's go materials. Threat starting to break down underneath the daily 200. New swing low. That's a concern. We go XLV, not holding the high and tight consolidation. I would still give this one the benefit of the doubt, looking for a daily 20 hold or generally a higher low here. Consolidation starts to build this out as like a pennant or something of the sort, and then maybe we're higher into the future. So still holding out on some degree of hope here. I would become a little bit more like full-blown neutral if we did something that looks like this underneath this pivot. Yes, double top, but still a massive range high breakout. I'd be thinking about that as the more constructive look over the span of a longer time horizon. Let's go utilities. Big breakdown possible here. Names like NEE are kind of interesting to look at for this. Underneath this bearish 3-bar play, you're probably looking at a thin structure retracement into the prior all-time high at 87.65. So once again, the highlight of this conversation, why we're walking through the sectors, is to just point out that the rotation thesis, it's not like, wow, it's perfect and beautiful and you're going to get these breakouts as tech pulls back and everything's positioned perfectly. It's much, much rockier than that right now. So price pays. You cannot argue with the index and what it's doing in terms of price, but you can be a little bit more selective in terms of where you decide to enter, how aggressive you are with your position size at the tippity top of the move, right? Those are the things you can control. So XLI looks like a failed breakout up here with the inverted hammer rejecting the all-time high 2 days in a row, really, on Tuesday and today's Wednesday session. Rotating into the midpoint, I'd be more neutral on this. This isn't as bearish as the XLF, for example. If we go to the XLY, kind of similar here, backing off of the all-time high, but still giving this the benefit of the doubt to build out over time, some kind of ascending triangle. And then if we get this, the basic premise, right, is that higher lows are going to be the defining component of whether or not this will break out or not. If it turns into a weekly balance in here and an equilibrium, then we will have to put our patience hats on until ultimately at some point Tesla decides to actually get in gear, and Amazon earnings, if that decides to finally get in gear. Tesla is just really, really lackluster on the attempted junk drawer range breakout, but Amazon even worse. Like if I zoom out on Amazon to like a monthly chart, that's horrible, horrible, horrible chart. Let's go to XLE. No comment, middle of the range. Bond market coming in, of course, as rates move slightly higher. And comms over here trying to catch a higher low at the moving average stack. I actually really like this. And I also like the fact that Google, of course, should help push this, pressure it in the upward direction. So comms probably worth a watch. This chart is clean to me, and especially paired with Google earnings. I kind of like the way that is resolving thus far. So that's your sector watch in the actual structural charts. Let's jump into our ratio grid and see what's happening over here. If you're not familiar with ratios in Thinkorswim, check out the video tutorial in the top right-hand corner. You can see this is still the glue. Is anybody surprised? Probably not. This is the similar look to what we have over here. Tech holds everything together. Financials look brutal. Communications don't look great. XLY still not really looking great. It's in a technical downtrend recently underneath the 50 SMA. But do we have risk off? No, healthcare is not overperforming, staples are not, and utilities really aren't either. So your one stock market is really being driven by tech. I don't think anybody should be shocked by that. If we come into the A set, you could see that we are looking good across the board here. That's primarily because everything is being referenced to some degree of tech or semiconductors. This is a little bit more of a pure play on XLP, XLY, so I do like that quite a bit. And this also starts to become pretty compelling. This is small cap growth versus value. What's not compelling is the fintech space, right? This is your ARK-K really not doing anything, the innovation ETF, right? I know that ARK-F would be a little bit more specific to the fintech, but you get the idea here. It's really not. It looks different. Simply put, it looks different than all the other charts. That continues to show that lag in anything that's not tech related. Let's jump into the B set. And we could see a couple of other things happening here. So gold finally, parabolic top, has gone off and is coming back down to earth. That's fine. I don't really think that this is a compelling argument for the broad market right now. This is, though, bonds underperforming the S&P, no flight to safety there. And of course, on Bitcoin, there is a little bit of a hang-up. You're not getting this follow-through in Bitcoin. As a matter of fact, sharp rejection off of that 117 area, the midpoint of this as a range. So until you can resolve that, I would be a little bit more reserved in the big bold Bitcoin call and need to see acceptance above the midpoint of that range and then threaten a range high breakout if the market's going to move substantially higher. For everybody who says Bitcoin is an inflation hedge and oh my God, QE is coming back, price action simply says wrong. Bitcoin is not an inflation hedge. It is a speculative risk on asset as of right now, which then you might counter argue and say, okay, well then if there's more money to speculate, then let's throw some in Bitcoin. Fine, I see you, touche. Let's keep going and let's take a look at the dollar and rates. So a little bit of a move higher on the dollar today, a little bit of a move higher on rates. Anybody shocked? No. Jerome Powell said, hey, odds of a Fed rate cut in December, we're going to slash those in half. Let's go on over to the inverted ZT, which will show us the same thing, basically higher, decreasing odds of a rate cut in December. If we take a look at the Fed watch tool, there it is. I mean, prior to the FOMC, these odds were at an 85% chance. Let me go look at this in another window. I should have had this pulled up. That's on me. But let me just grab this real quick. I have the tweet link right here. And this is, some really smart guy had the foresight to take a picture of this thing. I guess his name is the Trade Brigade Co. No idea who that is, but I guess he had foresight. At 8 hours ago, I took a snapshot, and it looks like there's about 85.2% odds for the December meeting, and as we just saw, those odds have been diminished down to 67.8. Not too long ago, it was almost over 90% that the odds of a 25 basis point cut in December were going to come through. So Jerome Powell's commentary today was pretty sharp and stingy. I do think, though, the market keying into that QE comment is really what we should care about. In terms of the economic calendar walking forward, all the fireworks here are in the rearview mirror. There's really not much to focus on with the continued government shutdown. We will let that be. Let's continue to take a look at the earnings calendar. So here we go. Meta, gap down. Microsoft, gap down. Alphabet, gap up. I believe Microsoft had a big hit and some one-time fee that they had to pay, which was weighing on earnings. And I don't believe Zuckerberg knocked it out of the park quite. Or maybe it was Meta. Maybe it was the other way around. One of them had a big fee to pay. I don't think it's all that influential for the stock. They're kind of just, honestly, in terrible ranges. Alphabet, Google, on the other hand, really impressive, clean chart, and we'll get into that stuff as we go through the core list of companies. And of course, you just have to be prepared for Amazon and Apple tomorrow. Honorable mentions to Coinbase, Reddit, Western Digital, as well as and Western Digital's hint, going to be a trade idea tonight. Western Digital, SanDisk, these storage names are pretty interesting. Strategy, which is no longer Micro, Riot, Roblox gets an honorable mention tomorrow morning, and probably the two healthcare names here. Not as concerned about the rail, healthcare, Chevron, Exxon, let all that stuff be. Okay, so Amazon, Apple, those are your main events, and some honorable mentions here Thursday after the close as well. With that, let's jump into our platform, or back over to the platform, I should say, and let's rip through the remaining supporting evidence here. Let's get into our bond relationships. No change on any of this stuff, which just continues to reiterate that the Fed is, and the market's perception is still that the Fed is concerned about labor and the deterioration there. Don't really care about inflation. That's backwards, I understand, but that is all set. So no change in perception. Let's go credit spreads. Still looking bullish here as long as we're underneath 50 SMAs, as long as the trend is generally down. That is bullish for risk appetite. Fine. Let's take a look at HYG. This is one of the red flags, right? So red flag here. Let's go SPX instead of LQD. And let's take a little bit of a zoom on the most recent situation. So another bearish indication, or a warning sign, is that you can certainly see the magnitude of the pullback here from the high is far more substantial in junk bonds. This, of course, indicates some degree of risk appetite. And if this is not chugging along with the S&P, then generally speaking, you start to become a little bit more concerned. Just like the S&P has made this, from here to here, a substantial higher high, this has only made an equal high. Notice also that this was correct in calling the turn out of the junk drawer, right? You had a low and you had a higher low, unlike the S&P where you had a low and a lower low that was incorrect, right? S&P technically had a high and a lower high. This had a high and a higher high. So generally, this has been the leader. It has been a confirming, a decent forward-looking indication in terms of divergence to help navigate the turn in the market. And therefore, once again, it's not enough to just go out and short the market because of this one divergence, but it might make you think twice about over-leveraging long at the tippity top of the move. If you're not already long from the breakout point down here, now is not the time. The HYG is just shouting at you, screaming in your face that exact message. Now is not the time. Let's take a peek over at and that could change, right? The HYG could get back up to higher tomorrow, but it's just not there yet. If we go to breadth, nobody should be shocked over here. We just saw this in the market internals, deterioration out of the 50 SMA underneath the 50% mark, and even the 200 SMA starting to finally roll a little bit more substantially. Notice how it was a little bit more sideways in here, unchanged. Now it's starting to feel the pressure. New highs versus lows has not gone negative yet. However, if we go take a look at the RSP, Let's jump over here. It is already, maybe get a little ahead of myself, but I was going to say it's already at the bottom end of the range. It's close. It's maybe a little bit more centered than I'd like to admit in terms of that breadth narrative, but why bother stick to the narrative? Let's just look at the chart that's in front of us. The midpoint of this range, it's not as bad as it could be, but the threat obviously is just a lower high here, whereas the S&P is just trading at literally the all-time high up here on a relative basis. So if anything, just make note of the divergence and how staggering it is. Sometimes when the S&P rallies, maybe you just go sideways here and you're like, that's bad breath. But in this case, massive gap and goes Sunday night into Monday, no follow through in the RSP, red flag, warning alarm, right? Lunk alarm. There it is. That's your sort of like little, I don't know, warning bell. Let's stop drawing and let's take a look at the QQQE. Similar, but not as bad. It is more aggressive on today's session in particular, which I would carry forward as noteworthy. And then we could take a look at our volatility indications. Small uptick, I think, post earnings on Thursday. This will normalize back to in here. And then unless the market pulls back and closes the gaps, I really don't see a reason for vol to get out of hand. If we take a peek at VVIX, even on the FOMC today, not over 103 on a strong close. It's right at it. I think, again, after the passing of earnings, you probably see a little bit of a downtick on VVIX, and our vol futures in terms of contango and backwardation, still all in contango, just waiting to see if this can hook up and over the second back month. So this is the front, this is the second back, third, fourth. I would like to see the brightest white line on top, then dim, 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 so on and so forth. But for now, still all in contango is bullish for appetite of risk and money managers allocating capital. One-day VIX, classic capitulation top on the release of the statement from the Fed, and then, of course, on Powell's commentary. So here's the release of the statement. Boom, comes in, drives the market higher on the first impulse. Here comes Jerome Powell, and boom, there is the mechanical crush. As of right now, lower, probably going to help the market move slightly higher as hedges come off and earnings pass through Google, Microsoft, Meta, Apple, Amazon, the whole 9 yards. Let's get back over to the classic charts here, and let's take a rip through the core list of companies. NVIDIA, like, what do you even do about this? It's a little frustrating to try to trade it intraday. We'll just take it one step at a time, but big bearish inverted hammer. Let's stick to the basics, take the chart at face value. Inverted hammer, selling pressure towards the all-time high, backing off, closing weak under the opening print. If we pull back, first thought is just a gap fill reversal attempt off of the Tuesday high. If you fail below that, it's probably a thin structure retracement to the previous all-time high. Do I want to overstay my welcome on the short side? Absolutely not. If we take a look at the hourly chart, here's your sort of bear flag. I don't even think it's a short into this gap close. I think it's more of a gap fill reversal attempt than looking for long. The market has really been rewarding pullback longs more than it's been rewarding chasing things at the highs. So this is a possibility in here, or this is a possibility in here. Those are the two outcomes that I would look for into the end of the week if NVIDIA is going to cool off. If it just consolidates, again, it's been a very, very difficult mid-October, probably October 10th, ever since the tariff debacle, which was now, 2, 3, 4 weeks ago. Ever since then, it's been a really hard market to try to take this trade right here. If you get involved and try to take this trade, you either have to choose the right stock or it's just not going to work, right? You need not even a catalyst. Some of the non-catalyst names have moved recently. It's been a very hard trade to take, is the all-time high Brigade Bolt over a prior day high. So just understand that if NVIDIA puts in that exact pattern. Here, probably not the best. And a good example of this, honestly, if you want to see this in real time, just go to a 2-minute chart and look at the open back here. Look at this 3-bar play, right? That's a classic 3-bar play. Opening drive, inside consolidation, long over the high, stop under the hammer low. I had to tell myself, do not click buy. Don't buy that setup. That is a bad setup in this market environment. Lo and behold, it was the right decision. And then as you zoom out, you're like, oh no, it wasn't the right decision, and it rallied. This is, of course, the NVIDIA event, so neither here nor there. Hindsight, of course, but in real time, those are not the trades that have been rewarding. Even if you look at this NVIDIA high of day from today, look at this pullback. Like, what did this net you? One simple pop that failed and then completely crumbled? These are very, very tricky things to trade. If you've noticed through the midpoint of October, it's not really been working fantastically. So that's NVIDIA in a nutshell. We'll move along to Microsoft. I do want to start with our earnings look, just so you can kind of see where we are forecast to open based on this. 522s is right about in here. So 20 SMA, midpoint of this range. The main thing I would encourage you to take away, we could even go to a daily chart and do the same thing. So 522s is back here. Look at where we're opening. Disappointing for Microsoft. This has been a horrible, horrible period of time to be trading the old guards of tech. I thought there was going to be a wake-up moment over here where, oh my goodness, it's going to go. I mean, it kind of went with the OpenAI deal, but I mean, did it really? It gapped up. If you were already long, then fine. But intraday action has been abysmal on these old guards. So I'm going to let Microsoft be and see what happens on the open near this 522 spot. Does it hold up over, I wouldn't even call it double bottom neckline. Heck, what the heck are we doing here? Do we hold up over 518.50 is the main thing from back here, and these rejections in here, and then the breakout, right? So 518.50 is the big spot to watch. If it can't, and it just drifts into here, there's going to be nothing to do on Microsoft, and it's just going to be another round of disappointing, waiting for the next thing, waiting for the next catalyst, waiting for the next whatever, or just a larger break underneath this. And then maybe, I know we're zoomed out on the daily, maybe this is like weekly double top, monthly double top. We'll talk about it when and if it develops. Remember, 522 is still here over that 518.50, but just disappointing in terms of price action. There's nothing to do, so let's move on. Let's go with Apple. Not much commentary on a lot of the core list of companies because of earnings. There's no use in doing it. There's going to be a gap, and whatever happens will happen. For now, though, this chart, let's just take a quick look. Apple's chart here is very clean, and it's a nice uptrend. If you look at Google, Google's very clean, and it's a nice uptrend. If you look at Microsoft, it was not a nice uptrend. It was sideways. This, absolutely beautiful, right? This in here, fantastic. Earnings gap up, killed it. So the sideways trend in here makes it almost untradeable. Now, take a look at Amazon. What do you think? What do you think is going to happen with earnings here? Ugly chart like Meta. Versus on Apple, like Google, what do you think is going to happen here on earnings? Now, I have no horse in the race. I don't care if this goes up, down, sideways, whatever. Long-term shares will be long-term shares, but I will never, ever take an earnings options trade through through the event. So for that reason, I don't really care, but it would seem like Apple's chart is more aligned with Google, the clean trend, buyers. People have strong conviction in the name. The iPhone 17 cycle has been doing well so far. That's my thought. In terms of the outcomes for the chart, this would be the best. This would be second best, and a gap up, of course, becomes hard to trade, but it would be bullish nonetheless for the stock. If we start to move back down underneath 258.65, this is where I'd be a little bit more concerned. Some kind of head and shoulders reversal emerges, and then we have to consider shorts underneath that level in here. To be determined. Let's not speculate too much until the earnings numbers are out. Let's go on over to Amazon. Same comment. It's the same thing we just walked through. Your guess is as good as mine. Are we going to gap up out of this? Are we going to gap down out of this? I don't really mind one way or another, but please, for the love of all things trading, get me out of this range. Get me out of this Amazon range. Tell Jeff Bezos to stop selling shares. Tell him to stop leaning on the ask and just like totally blowing this thing out. Horrible, horrible action in this range. Gotta be here. Gotta be here. One or the other. Show me something. Yeah, like I said, you could go to a monthly chart, weekly chart even, and you could just see this. There's no trend. Right? You could say lows, higher lows, and that's fine. You could say, something that looks like this is probably more bullish if we can crack the highs. That's great. Cup and handle, V-shape, there's your V-shaped mug. Whatever. I get the idea of the higher low. I'm on board with you. But the range is just untradeable. There's nothing to do in a non-trending Amazon market. Google earnings after hours is certainly higher. So you could see 290 bid-ask spread up here. That's a sizable gap up. That's up to 290 there. Let's take a peek at the expected move on earnings. 291.96 would have been the upper edge, so well contained within market makers win again. If you are long calls, you're not going to get paid, unfortunately. I don't laugh out of hate for you as a trader. I laugh because it's an age-old mistake to try to swing trade just net long options, long calls, long puts through an earnings event. It's just a lost cause. 9 out of 10 times you'll lose, and the one time you win, it's not even going to be as much as you think. So Google, upper edge of the market maker expected move, all the IV crush tomorrow morning. If you are long calls and you have any semblance of profit in the position, probably just kill that. As soon as IV opens up, it will start to crush out. You don't want to be a victim to that. So point being is Google is going to be in blue sky territories. If we were to pull back, gap fill reversal, of course, will be nice. Anything over this range high would be nice. I just don't think we get that. That's not going to be a day one Google tomorrow morning on the earnings gap up. You might get a partial gap fade off of 290 here, and then it comes back into range, and then we build out a new cluster. If you remember back to, I guess, where would be the best example? This was the lawsuit gap up. If we go on over to, not Apple, there it is, Microsoft. go over to Microsoft, like something like this that then builds out. I really hope Google's not dead in the water post earnings like this Microsoft, but have to keep an open mind, just have to continue to watch the chart for what it's worth. But as of right now, very bullish. I like what's happening here. The earnings segment is only going to, in my view, continue to fuel the bulls here rather than the bears. If we look at Meta, it is gapping down post-market, so 697, ugly chart. 697 puts us right around in here, just shy of the 700 figure. So just like Amazon, what is there to do in this? There's been nothing to do on Meta for a while, unfortunately. So I would have preferred if we could have gapped under the daily 200, just totally blown this thing out and built out a new base somewhere and better trades, momentum, volatility. I'm hopeful that we get some degree of volatility and momentum, but I'm just not seeing it yet. I don't see the argument for it as we're still just near the range low. If anything, you might say, okay, daily 200 hyperscalers are going to hyperscale and Meta is going to be a big part of that. Maybe along off the range low in the daily 200. At least it's tight risk. If we gap down to here and come in and test it, you could go stop under whatever tomorrow's low is and then look for the high, a rotation back to the highs. Maybe. But unfortunately for day trading, it's been horrible in here. Let's keep going. Tesla, no earnings, of course, so this is like a little shining spot. However, it's really not that shiny. On the attempted breakout here, I do like the inside bar today. We'll get to that in a moment, but as we break out of the junk drawer range, volume taper is not what you want to see. As you break out of a range, you want confidence. You want everybody and their brother, sister's mother looking at Tesla saying, hey, we're breaking the range. I guess I got to get long Tesla. You don't have that right now. And you could make the argument, well, we're not truly broken out yet. You could say this high needs to break, and that's fine. I could get behind that. But it just means that the risk reward here is going to get kind of tough into the all-time high resistance area, right? So what would be best is, honestly, if Tesla could gap up over this, gap over that high. I'm not saying it will tomorrow or anything like that. It's actually slightly lower in the after hours. But I'm talking about as we're looking to navigate this breakout in terms of game planning different scenarios, the best scenario might be some sort of gap up over this high, gap fill reversal, or a Brigade bolt, just straight up opening drive over the all-time highs. That way we're just trading into blue sky territories right off the rip instead of having to open in here, start the break, and then you're like, oh, is it going to reject the all-time high? Is it going to get hung up here? The risk reward's no good. My stop's too wide. The target has to be there. The only way that you can trust it is to say, okay, I'm going to size this, not exactly for zero, but I'm going to give the stop way more breathing room. And if it goes, it goes. And Tesla has that 7% up day. You get paid, but you're probably using smaller size than if you could manage your position based on a cleaner setup that unfolds more nicely, more respectably over some of those key levels. So just some thoughts on Tesla and how that might unfold. I do like the inside candle from today. It's oddly reminiscent of Palantir. Palantir also had a junk drawer. It gapped up, gave 2 days of consolidation, and it broke out today, actually. So we'll see if we can get over those highs on Tesla by the time the bell rings tomorrow. On the hourly chart, not much to really read into here. I do like the hold. I like the constructive look for higher lows. I like that it's trending finally. But in terms of momentum breakout, the volume is absolutely not there on Tesla. Let's take a look at JPM. No comment, really. I'm not interested in trading this right now. It's just too middle in this range. It's round-tripped it already. So a lower high perhaps becomes bearish back down towards the lows, but not interested. There's other opportunities that are even better. If we go look at Palantir, there's your 2-day balance range, just like Tesla. After the long-standing consolidation, breakout today, and close strong at the highs. I am interested in looking for Palantir continuation. Notice the ignition in volume. This is better than what we saw in Tesla. Earnings are next week, so I could still trade this Friday's options expiration and not have the concern about pumped up IV coming back to bite me if the stock pulls back. Obviously, they'll expire before earnings are even an issue. So in my view, I love Palantir here. Nice high and tight close. Look at this consolidation. You get two outcomes. This Brigade bolt over all-time highs, pull back here, attempting longs off the range high again, back to the highs. If you go gap up tomorrow, I would prefer gap fill reversal that then longs over the opening print. If we have to chase it on the high, it would have to do something special. Very, very special. And all that means, I don't know what that special thing is. It would need a catalyst, of course, but the only way you'll know it's special is if the volume on a relative basis is through the roof. If in the first 10 minutes of the session, you're trading something like 30% of the average 30-day volume, 50% of the average 30-day volume, and everybody's watching Palantir, everybody's trying to get on the long train on this breakout, that's when you know you've got those special ingredients, and it might be worth a stab on that big bull flag up at all-time highs on a gap and go. If it doesn't have that, if it's trading normal volume, you guys should be tracking this stuff. I mean, if I just go take a look at, where is it over here? I could show you. real quick. Where is Palantir? Click on Palantir. There we go. Like here it is. This is Palantir this morning. Let's just do that real quick. Take a look. Volume at 7 a.m. was around 272,000 shares. Okay, so Palantir was a watch, and if we get more than 272,000 shares, great. I know that we're trading relative volume that's higher. We have tools for this. If we go to Tesla, we've been tracking the same thing. Point is not to really get too deep into this volume bit, but I'm talking about in terms of executing on this setup, it's got to do something a little bit more special other than just kind of fizzle out near the high with no interest, okay? That's Palantir. Broadcom, what do we have over here? We've got 383 pullbacks look good for something that does this. It is gapping up after hours. Actually, it's 389s already, which is here. Broadcom is just on a tear. Look at the daily breakout of the balance. Look at this happening here. So a nice break. It could have some legs behind it. I really would have preferred a pullback to here over the top of the range. You don't always get what you wish for, obviously, but that would have been the best outcome, and then a more constructive look rather than just range low to the high and a breakout, right? Typically, when you 100% retrace something, you get a pullback first and then go. Anyways, it's, if anything, a sign of strength, and the gap up tomorrow continues to keep this on my radar. So Broadcom, interested for that. Let's go AMD. A little bit soft up here towards the highs, lacking the momentum. Earnings next week, so just be mindful of that. Consolidation is bullish. Brigade bolts are bullish, although once again, unless it does something special from a volume perspective, I might be a little wary of chasing that at the highs on the classic Brigade bolt out of range, because that setup just has not been working over the midpoint of October. Let's get into Robinhood. Sorry, let me go back to AMD for just a second. Apologies. Just because this is absolutely an opportunity. A better opportunity would be a deeper pullback to this level that then goes, right? Pullback longs are the name of the game. Trying to jam it long at the highs, not the name of the game through October. Let's go Robinhood. It was the name of the game in September, early October, like the first week, but definitely not the back half. Robinhood, what do we have over here? It's the conjoined twins pattern. It's this. It's a double top that then shares a neckline with a double bottom. As long as we're over the 141, bullish earnings next week, keep that on your radar. But I would love to see pullbacks that test it, daily 20 SMA. I really like that Robinhood 141. If we can get there, I want to be not all aboard the long train, like too emotional and, oh my God, it's the best trade ever. No, it's just a reasonable take. It's a reasonable trade opportunity here on Robinhood. If we could get that test, 141, can we pick it up long? Can we trade back up towards the highs? Even if we just trade back up towards these local highs, that would also work. Tight stop, tight risk, 20 SMA is right there to support. Let's get into a couple of these ideas. I already told you one of them, so we'll start with that. WDC is the first, and they do have earnings, but I just love this chart. This chart it's already gone parabolic. It's consolidated for a little bit. Anybody who was trying to short this for a backside move never actually got a lower low after the first attempt, right? So this is more so consolidation, high and tight consolidation, call it a bull flag, whatever. And now you've broken the high. So I think this has the opportunity to squeeze. Look at the volume. I know, again, earnings, but if you could find the right setup on this with shares tomorrow, I would stay far away from the options market here. Oops, click. There we go. Let's go with the delta volume open interest. Stay far away from the options market. There's no need to be playing around with something with a 90 cent spread on the at the money call, trading 42 contracts. Stay away from the volume, the options contracts. But with shares, if you could go shares like this, boy oh boy, that's beautiful. If you could go Brigade bolt gap and go over the high, that might be beautiful. Earnings right around the corner. Everybody's sort of getting squeezed out of this from the short side. You have to imagine shorts don't want to hold it short through earnings. Those are my thoughts on it. It's a little bit of a speculative play. You probably would use smaller size on this. It doesn't really fit an A+ standard category of playbook. It's more of one of these momentum parabolic runners that's getting some extra fumes after the whole September. September was one heck of a month, but this is looking like it's catching a bit of a second wind. You could go to SNDK, which is SanDisk. Just taking a look at this one. Earnings are a little bit further out next week, so it's still not an options contender. There's just not enough. There's no volume here. But if you go on over to the shares, they're getting a little pricey now at 200. But for a scalp, again, be cautious of chasing this long on the high. But you get something that looks like this. This is the ignition bar. That's the equivalent. You get the follow-up, gap and go. The only time to short this for a backside capitulation move is if you gap up and then take out the previous day low, right? That is the short right there, here. not on the gap up, personally. That's my take, at least. I tend to not like shorting the failure back under the opening print, just because you still have gap fill reversal that can keep things afloat. That's my personal take. You could maybe start to get into it on a lower high underneath the previous day's high. There's methods to that, but the way I would trade the backside capitulation on a sort of big parabolic move is on this move right here, the move underneath prior day low, right? And that is the same thing. We've been doing this on gold. Whenever GLD does it, there's two examples that come to mind. This day back here, this day back here, and this day over here. Those three were great examples of it, okay? So that is that, and that's sort of like three ideas in one, or one main concept in one, but that's WDC. Let's go Oracle. Oracle is up next. Oracle looks great for a possible short, believe it or not. Notice how you have lower highs marching into this thing. Rejection of the daily 20. It's not participating in any of this NVIDIA euphoria. It already had its moment on earnings. It already had its moment with the $100 billion OpenAI, this, that, the other thing, right? So the moment has come and gone for Oracle, and now it's time to put up or shut up. And they've already tried to put up once, and guess what? Those leasebacks don't really work well, right? That was the news headline there. So if we flush this low, you got nothing but gap, right? Not nothing but net, but nothing but gap. Below. These prior highs would be my first target, then the full gap close at 244. That is Oracle, if we can break down under 271 with a Brigade bolt. Let's go SOFI, and then we're out of here. What do we have on SOFI? Post earnings, great looking Brigade bolt possibility over 30.25. All-time highs, break out of this consolidation. If this can hold in here, this looks really, really good. I love this chart. It is post earnings. I love how we on earnings day dipped in, closed back strong near the highs. Not too fond of this daily bar from today, but if we can resolve this based on the Powell volatility issue, all right, you can see in here at 2, this is where we sort of overshot and then stayed back above. If we could continue to hold in here, I think that would set up a nice opportunity for a long over the top end of that balance. So SOFI definitely hits the scan as the last and final trade idea for today's episode of the Midweek Market Update. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will have to re-update the charts based on earnings from Meta, Microsoft, Google. We will have Amazon and Apple on Thursday after the close. Please keep an open mind to this stuff. Of course, for the latest, most up-to-date analysis, just come back out to the pre-market show every morning, 8 a.m. Eastern time. We'll be right there to walk through the charts, build a game plan, the pathing ideas, the ES, NQ, and the core list of companies, and any additional things that are really moving and worth talking about. So with that said, enjoy your evenings. Have a great and green, profitable rest of the trading week. Keep it green into the end of October. Have a great Halloween, everything that you should have. Let your lives be great. Have many profits from the market. And as always, I will talk to you in the next one.